The go-to stock exchange for the world's biggest tech firms just dropped an extraordinary sum on some tech of its own. Nasdaq might be best known as the stock exchange home of firms like Apple and Microsoft, but it's trying to be much more. Chief Executive Adena Friedman on Monday announced a $10.5 billion acquisition of a software firm called Adenza. Yes, that's Adena with a Z, from private equity firm Thoma Bravo. The idea of this deal is to catapult Nasdaq further down the path of diversifying away from its reliance on stocks and initial public offerings. Now, Adenza makes software that helps banks deal with regulatory requirements and investment firms manage their risk. It's also got reliable, fast-growing subscription-like revenue, so it's the opposite of the lumpy boom-bust fees that come from Nasdaq's traditional business. This is totally in tune with the new Nasdaq that Friedman has said she wants to create. The problem is that this deal is really expensive. Nasdaq's paying 31 times Adenza's EBITDA, a measure of profit that private equity firms like to focus on. Nasdaq itself trades at just 16 times EBITDA, and as part of the deal, Thoma Bravo, the seller, gets a 15% stake in Nasdaq and a board seat. So in other words, Friedman is giving away influence as well as cash. That might be why Nasdaq's shares fell 12% on Monday. Now, it's never good when a CEO's first big acquisition in 5 years gets that kind of thumbs down from investors. It might look smarter later if Adenza wins Nasdaq a bunch of new clients, or if investors eventually decide that the new Nasdaq deserves a higher valuation than the old one. But as the CEO of an exchange that hosted 2000's legendary dot-com boom and bust, Friedman should know better than to trust the whims of stock market investors.